we speak to you every jobs report. And again, the narrative that's out there is that this one in particular is a little bit of a sideshow. So talk us through what fundamentally has changed for you since now and when we spoke to you about a month or two ago.
Thanks, guys. Thanks, Katie. I don't know, decades of experience. I don't know, that sounded daunting from an age perspective.
I wanted to make you sound like you have gravitas, Rick.
I understand. I appreciate that. Did we have a jobs report today? It is. This is one of the. This is one of those reports. Interesting, but I'm just writing a piece where I said next month's report is going to be very interesting. Listen, I mean, you can't write it off. I mean, when you look at it, you've got a jobs market, particularly the service sector, that just continues to hum along. I focused on healthcare and education, leisure and hospitality, pretty solid. And so, what does it mean? I think you're also going through this extraordinary sentiment shift, and looking what the data is going to be over the coming months are going to be fascinating. But today's report, it was look at it. There's some interesting trends within it, but we're going to quickly forget about it.
The Trump administration put massive tariffs on China. China is striking back with massive tariffs on the U.S. How does this play out for our economy?
Listen, I mean, in the near term, and similar to what we talked about, there's a lot of discussion about recession. And, the way we define recession is interesting. You get a couple of quarters of negative growth. What I actually think is happening is you could have a downturn because of people sitting on their hands. That could be pretty intense over the short term. I don't think it's, quite frankly, I don't think the timing is at 2 quarters or 3 quarters or 1 quarter of softness. It's the intensity of how much do people sit on their hands for a while. So, listen, I think it's going to be, we're going to have a softer period. I think you have to build that into your asset allocation, how you run risk, because we're not going to know, at least for a few weeks, what the ultimate outcome is. When will corporate CEOs start to do more in CapEx, R&D, M&A? Well, my sense is it's going to take a few weeks for that to play out. But I think you have to build in any portfolio. There's going to be a soft patch.
All right, so you're saying a softer period, a soft patch. I want to go to a note that came out this morning from George Saravelos over at Deutsche Bank. He wrote that the market is doing one thing, pricing in a global recession. Rick, it sounds like you don't quite see that yet.
So, no, I see some significant slowdown in the near term. Like I say, whatever we call it or whatever we term it, I think you got to manage your risk. And I talked about it last week, a week before. I think you got to pull back on risks that you take within portfolios. And I think you're going to see some tangible slowdown in terms of, what orders go through, how do companies think about their inventory development, how do they think about what cost of goods sold is going to be, what does it mean for margin? Do you have to start to make some inventory adjustments, CapEx, people adjustments? So, listen, I think your portfolio has to reflect that this is going to be a weak period. And,
right.
The question of defining the durability of that, I'll say one thing that's very different when people think about spending. CapEx you put in place for 5 years, 10 years, sentiment can change amazingly quickly. And so we're in this period where sentiment now is going to be really tough. That can change. And so I think you got to think about, how do you position, what are the conditions that you'd operate in where sentiment, my sense is sentiment will change quite a bit, whether that's a month from now, 2 months from now, or 6 months from now is going to be the key for markets.